Welcome, viewers. Today, we're going to dive into the exciting world of options trading and explore a powerful strategy known as the butterfly spread. For those of you who are new to options trading, don't worry. We'll break it down step by step and provide examples along the way. So, let's get started. The butterfly spread strategy is a popular options trading strategy used by experienced traders to profit from a range-bound market. It involves using a combination of call and put options to create a unique position that can generate profits when the market stays within a specific price range. To understand butterfly spreads, we first need to define call options. A call option gives the holder the right, but not the obligation, to buy the underlying asset at a predetermined price within a specific time period. In the context of the butterfly spread strategy, call options play a crucial role in setting up the strategy and defining the risk-reward profile. Now, let's move on to put options. A put option gives the holder the right, but not the obligation, to sell the underlying asset at a predetermined price within a specific time period. When constructing a butterfly spread, put options are used in conjunction with call options to create a balanced position that can capitalize on a range-bound market. Before we delve deeper into the butterfly spread strategy, let's talk about what a range-bound market is. A range-bound market is a type of market condition where the price of an asset stays within a specific range for an extended period. This means that it neither breaks out to new highs nor drops to new lows. The butterfly spread strategy is particularly well suited for this type of market, as it allows traders to profit from the lack of price movement. Now that we have a clear understanding of the key concepts, let's break down the process of implementing the butterfly spread strategy into easy-to-follow steps. 1. Identify a range-bound market. 2. Determine the desired range. 3. Select the appropriate call and put options. 4. Construct the butterfly spread position. 5. Manage the position throughout the life of the trade. By following these steps, you'll be able to effectively apply the butterfly spread strategy in your options trading. To solidify your understanding, let's explore some real-life examples of successful applications of the butterfly spread strategy. We'll analyze specific scenarios and discuss the outcomes, highlighting the factors that influence the trade's profitability. By learning from these case studies, you'll gain valuable insights into the potential of the butterfly spread strategy. In conclusion, the butterfly spread strategy is a powerful tool in an options trader's arsenal, allowing them to profit from range-bound markets. We've covered the basics, including the definition of the strategy, the role of call and put options, and the steps to implement it. Now it's your turn to take action. I encourage you to try out the butterfly spread strategy and see how it fits into your trading style. Remember, practice makes perfect, so start small and always paper trade until you fully understand your process. To get a detailed example of a live butterfly trade played out from start to finish, go to the link in the description below. Happy trading!